All right, good afternoon, everybody. This is event trader Gavin McGuire. I'm being joined by chart trader Brett Manning here on this Thursday, November 18th, 2021. Brett, how are you doing today?
I'm doing fantastic, Gavin. How are you?
Doing pretty good. Doing pretty good. We're keeping an eye out on market activity here. We got options expiration tomorrow, a couple of key events that are going to be coming up that we'll get into later on the discussion here, based around possibly a new Fed being Fed chair being named, uh, CBO ruling on the latest budget reconciliation bill. So a lot on the table that lays in front of us. But Brett, we're going to take a look at some of the recent action in the markets, some of the positioning that we're seeing in sentiment data, and see if we can figure out which direction we are going to be going. Now, the last time Brett and I were talking, we talked a lot about the cash that was on the sidelines and the idea that sentiment could continue to bubble up higher and lead to a further breakout. And that's exactly what we got. Brett, you got any thoughts over the price action of the last couple of weeks?
Yeah. So we saw the kind of melt up, big chase coming from what we kind of felt was maybe larger fund managers who had lost enough exposure and maybe misjudged the degree of retail interest that was going to come back in on the pullback and chased back in, and that really gave it some afterburners. But over the last couple weeks, I'm going to tell you, there's been a serious deterioration in breadth. And I don't know if you guys have been talking about this, but you've
Yeah,
got,
yeah, the advanced decline lines. We've been
well,
mentioning
and look
that
at
a lot.
the XLF is red on a trailing 30-day basis and it's making new lows today. JP Morgan's on its way to 7 straight down sessions. The XLE is red on a 30-day trailing basis, making new lows today. And that's going on with the RSI on the S&P 500 at almost 70. So there's huge macro, like you can look at the S&P, but underneath the surface, and the McClellan oscillator is way negative now. You're talking about the advanced decline line. There's a serious deterioration in breadth going on over the last, let's say, 2 to 3 weeks under the surface. Now you could say that there's trees and not a forest, because you could say that the XLF is a big part of that, and maybe they're hedging because of the possibility of a change at the Fed, where you have more stricter regulatory oversight.
Right,
And
with
you could
with
say
Brainerd going in, higher capital levels
it
expected to.
it could be some hedging for that. It could also be that the XLE has to do with, what's going on with the possibility of an SPR release, the Strategic Petroleum Reserve. So you could say that there's individual idiosyncratic reasons for a couple of sectors, and that's causing the appearance of poor breath. But sometimes when you start to do that, when you start to discount things that way, you're starting to miss the forest, because there's a lot of deterioration. I think when you just kind of scroll through a lot of different stocks, there's really a few themes that are booming right now and that are really sustaining the momentum of the broad market. But there's a whole lot of stuff that's starting to gradually look a little bit toppy.
Yeah, that at times it feels like Tesla's kind of raising the entire market.
And Nvidia, yeah, right.
Yeah, Nvidia, your AMDs of the world.
Hmm.
Certainly, the metaverse names have been getting a nice boost, and we've really seen a return to growth. But let's break down some of the data that we're looking at here, Brett, and figure out if we could see if that is a serious deterioration or across the board, or if this just happens to be possibly some industry specific headwinds that are facing us. And the first thing that we're going to take a look at that we usually do is the AAII data, which was updated yesterday afternoon. Coming in, we did see a big decline in bullish sentiment, which is interesting because I feel like it kind of changes the tune. If we had done this a week ago, Brett, and we're going off that bullish sentiment, I think both of us would have been talking about it being a little bit of an extreme and expecting a pullback. And
Yep.
now here we are a week later, and we certainly got that pullback. Seems like the majority moved into the neutral camp. Neutral is at its highest level since just the October 6th reading, which of course would have been just before what's been a pretty strong Q3 earnings season. So when you look at the AAII data, is there anything that's jumping out to you here?
So week to week changes, I try to discount in my mind. If you kind of look at the entire list there under the bullish side, you can see where we were at sort of in, July and August and during September, you see a lot of 28s, 22s, 24s, 25s. And then you get to the last few weeks and you've got, I mean, look at the average over the last 5 weeks. Now we're down to 38.8, but that's well above the long-term average. And we have 48, 41, 39, 46. So it's been clustering at levels that are still, generally speaking, um, whereas you're well above the long-term average in terms of the number of bulls in this survey. So I would say, even though it downticked 10% in this last survey, and we saw a lot move to neutral, but not move to bearish, just a little bit moved into bearish. But really, if you look at the kind of clustering over the last 4 to 6 weeks, we've had a period where there's probably been a lot of speculative positioning coming into the market. And so that's probably not this move down to 38 probably doesn't mean that people have hedged or liquefied those positions. They maybe just aren't quite as sure that the market is going to take off that much further to the upside. So the vulnerability implied by that is still, I think, present.
Yeah, and then we just transition to sentiment traders AAII bulls chart. You can kind of see what Brett's talking about here with that steady rise coming in, and we do see this crossing through that red line threshold down below, Brett, which shows an extreme optimism. It's a little bit of an inverse chart. You got any thoughts on this AAII bulls chart that we're looking at?
I think the main thing is how fast it shot back up to the red line in a correction situation. So we saw the pullback, and the second stock started to tick up, this shot right back up into that area. And if you look at the last several months, for most of this year, really, it's clustered up around the red line. So, and this is kind of how this indicator works. You really don't want to look at a week to week. You want to look at, is this a period where a lot of people have put themselves in a position where we would be vulnerable if we started to see some headwinds, like let's say what Williams came out and said today. Let's say that starts to be contagious on team transitory, and we start to see a lot of folks starting to get right up to that boundary where they're sort of on the verge of defecting from that notion, and suddenly the Fed is going to be something that's much more about stopping inflation than it is promoting growth. And if you've got a lot of speculative money in the market, that kind of shift can cause a lot more damage than it would if this had been clustering by the green line.
All right. Let's take a look at the VIX term structure, Brett. This is basically the relationship between VIX future prices and maturity dates. We have been seeing this chopping around as well. We got this again under the at the extreme optimism. This time the red line, as you can see on the chart here, down below, and it's also breaching that level. Uh, Something that we've seen across a number of the different metrics that you like to follow here closely, Brett. So, with that in mind, what's your thoughts here on this fixed term structure, and how do you equate that to the bullish data that we've been seeing?
So I mean, it's been clustering again, not to overuse that term, but it's been clustering down by the red line, which means we're going through a period right now with an abnormal lack of appreciation for the potential for a sudden emergence of near-term volatility. So what this indicator really shows is near-term versus distant horizon volatility. It doesn't really tell you that people aren't seeing, let's say, a big bear market in 6 months. What it tells you is right now people feel that they're sort of in the clear for something that would be much more like a traffic accident for the market. That there's nothing that's coming in the next month or so, and probably that's a seasonal thing. I mean, that's
Yeah.
reasonable in Q4 heading into the holidays, and the Fed is still holding on to their messaging, and there's a lot of a willingness to say I don't really need to be hedged right now for something that could go wrong in the next few weeks. Even though one could argue maybe the debt ceiling is an issue there, maybe the Fed share is an issue there, but there's not appreciation showing up in positioning on the VIX forward curve.
Well, it's funny because I do think that the Fed share, I don't believe that there's an expectation for a marked change in monetary policy. So from that, I find the Fed share move to be very industry specific in terms of against the financials,
Mm,
and then the debt ceiling. I think people, there's a little bit of a boy cried wolf, right? Where ever since S&P downgraded the U.S. was that in 2013, I think,
hmm
around the debt
11,
ceiling.
2011, I think.
2011 was it around the debt ceiling debate. I think most people feel like this is just gamesmanship that goes on. So
Do you
obviously, there's
really
a bit
think
of
that? See, I would take
I
issue with you there a
do.
little bit. I would
Yeah.
say that we're in a more polarized political environment than we've seen in our lifetime, and certainly way more than 10 years ago. there's no willingness whatsoever to compromise and work together towards some common destiny between the two parties at this point. I could believe anything right now.
Yeah, I suppose so. I mean, until it happens, so I think it's a boy that cried wolf scenario where the market's just, I mean, it's kind of being reflected in, I mean, you never see the markets move on yelling comments about when we're going to run out of money or anything like that,
No,
in my
right.
opinion.
Right, but
So,
that may be, that may be sort of a black swan possibility. Even though
well,
I agree with you,
that,
most
yeah.
likely it's not going to turn up, you know, uh, uh, craps on this one. But
I'm saying from a general market perspective, I don't think portfolio managers are managing their portfolios around the idea that we're going to default, I
which
would
is
say.
shown here in this VIX term structure chart,
Exactly,
right?
exactly,
And the next
and
one,
that would be, my point, and the next one, the SPY liquidity,
yeah.
which, again, one that's gone into extreme. Do you think that some of the SPY liquidity, Brett, is, I mean, obviously it kind of plays into the breadth argument here, but also from the idea of, stock, it's more of a stock pickers market, and therefore people feel that they could be a little bit more effective by getting into the right stocks. And certainly it seems like there feels like there's been a group mentality where certain stocks are just blow away winners. Everybody's buying Nvidia, everybody's buying AMD, and therefore that SPY liquidity is getting into a little bit more extreme optimism levels. Would you think that's in play?
I absolutely do, and I totally agree. So this turns down every 3 months, and that's because we go to earnings season. And in earnings season, obviously, most of the capital flows. You've got low turnover funds that do big repositioning in their Apple position or whatever. So a lot of the capital is really tied up in reacting to earnings or anticipating earnings, and it's a really bottom up marketplace. But this is lagged down there, and it's gotten steeper down there. And I think that you're right. I think another way to look at that is it's another signal about the importance of retail participation in this market because they're not really interested right now in doing a lot of index trading. What we're seeing is a lot of single stock participation, particularly using the options market, and a lot more of the share of volume is probably coming from retail market participants as a total share of overall trading volume in the market than it has in years right now.
All right. Next up, we've got the name exposure index. This is basically another one that, as we can see in extreme levels, this has been in extreme levels, really for the majority of the last 4 years. I would say certainly a couple of hiccups here and there. That big drop down around the pandemic, but I guess we should expect this given the what we're just talking about with the bull sentiment data that we're seeing, because this more or less is just a compilation of that in another chart form. Am I right in reading it that way, Brett?
Yeah, yes. I mean, well, but it's so this is active investment managers, and if they're well above that red line, it means that they are actually levered long in the market. And this is long short, so they could be levered short in the market when it's down by the green line. So this is the net on that, and yeah, I mean it's clustered way up there, and there's been people just trend following and staying long the market, and it spiked back up to near highs. But the way that this has been going during this leg of this bull market, this hasn't been a particularly tremendous contrarian indicator, but it does show you how one-sided exposure is in this market right now.
All right. And then the last chart that we're going to look at from the sentiment trader. We haven't been looking a lot at options trading, Brett. You've been all over the story really for the last year and a half with the kids with calls activity
Hmm.
that's kind of disrupted our ability, which we used to use this a lot as probably our primary read with the robo and lobo
Yeah.
ratios, but it's been a little bit more difficult because, as you've been saying, everyone's gotten involved in options trading
Hmm.
primarily from the call side, and it's really
It's polluted
um,
the sample from what we've seen over
exactly,
the last 2 decades.
exactly. But the small trader call buy, this chart did jump out to you this time around, obviously elevated. What were you seeing in this that really wanted you to talk a little bit deeper about the action?
Okay, so one thing that you can do is look at recent relativistic measures in options data. So once we have the kids with calls dynamic going, it peaked, probably its greatest peak ever was in late January, early February, earlier this year when we had the meme stock craze. And so much of it was driving into just a handful of stocks, but the volume was so high and it was so much call buying and so much on the retail side. And I mean, they almost put a couple hedge funds out of business by the retail warrior coming up and beating up on Wall Street because of this massive kind of herd movement. And you can see on this chart that's shown there. That's the highest level this index has been, is right during that period, end of January, early February. And so the point that strikes me is we had a spike in June that receded quickly, but now we're right back up there. We're very close to being back at that same level that we were at during the meme stock craze, which did introduce a broad-based correction in the market once it subsided. So, this is something to keep an eye on. If this nudges up and starts to get to those levels, how much is sustainable before the market gets too one-sided that it's basically mechanically destined to need some kind of serious corrective or consolidative phase. And if this is the motive that's driving things, especially if we're seeing some of this lack of divergences and some of this lack of Wall Street direct participation, we're going to talk about a little bit later. We've seen outflows by fund managers from the tech sector. And obviously, the tech sector is not going down. So, we're going to talk about that as kind of a handoff. But if the engine that's driving that gets to a kind of extreme level that's really unsustainable, then this becomes something to really watch out for.
What do you think this chart would look like in a sell-off, Brett? I mean, do you think that some of the options traders, the retail options traders, are savvy enough to use puts effectively, or do
Yeah,
you see them kind of getting blown up by the bigger players if they try dabbling in either naked shorting of calls or put buying?
I think it's a super interesting question, and I really don't know. I mean,
Yeah,
I think it would need to be a sustained period of downward trending where we got to extremes of sentiment that are bearish in the market, sustained downside movement to kind of get the herd to change and say, wait a minute, there's another opportunity here. We could make tons of money on these puts. I don't know if it would happen quickly, though. I think the first thing that you can think about when you see a market driven so much by options action, you have a short leash on everything. This is a weak hand driven market. So it makes margin calls closer to the top. Really, if you have a share trading driven market, you need a bit of a sustained decline before you start getting those margin calls. But if everything is all levered on small
levered,
accounts,
right?
yeah, right, you really got just it just takes a little bit of downside. We saw it in September. We saw, we had a creeping downward move for a few days, and then really on no headlines, we had a huge down day. Just the market imploded in mid September and then snapped back and then sort of imploded a bit again. But I think that's where you started to hit all those margin calls when Evergrande became the story, and people just
Right.
got they were just too tight. They were too tight, too levered.
Yeah, and it'll be interesting to see these charts, and we'll continue to be monitoring them, see if there's any change in activity. Really haven't seen anything throughout the course of the year, which is why we haven't been discussing it. But we continue to monitor them just to see if anything does pop up. And like I was saying, I'm going to be real curious to see if they'll be savvy enough to use puts on a down market. Not that's going to be one of the more interesting stories next time we get a correction.
Yeah,
All right, Brett, let's move on to the Bank of America Fund Manager Survey. And we'll also be sprinkling in their flow show data too that's been coming out the last couple of weeks just to kind of track where money's going. But some of the primary items that we've seen, the November Fund Manager Survey was definitely a little bit more constructive than what was a pretty bearish dive in the October view. That would have, of course, been data all at the start of earnings season when everyone was a little cautious about supply chain constraints and rising costs of goods sold that was expected to crimp margins. So far, the data that we've gotten from the companies have been excellent. Right now, we're getting a great round of results from the retailers as well. And that's a question I'm going to have for you a little bit later, Brett, but we'll save that for later. For now, we'll continue with the bullets. Second bullet there, biggest overweight stocks in history. That means I think 66% of fund managers in the survey said that they were overweight stocks. Cash levels were near the lows, down around 10%. And basically, those two data points reflected the risk on environment that we're looking at. A rise in expectations of inflation being transitory, and that's going to be interesting because we're going to talk a little bit about the CME Fed funds futures and how that could be a little bit of a disagreement there, and also some of the recent Fed commentary that we've had. We'll also get into the expectations for the best performing asset classes in 2022, with a lot of people throwing their weight behind emerging markets having a nice recovery year. Then investors reduced their value versus growth exposure and increased momentum versus quality exposure. And, that's kind of what we're just talking about in terms of the breadth and where the winners have been. And then net 5% of fund managers, investors are taking higher risks. That's lower than what we've seen. And just a correction here, it's the biggest overweight stock since August of 2013. So Brett, real quick, just taking a look at some of those bullet points. Is there anything that's jumping out? We'll obviously dive into each one a little bit more, but anything off the bat that jumps out to you? Brett, you still with us?
Sorry about that.
Yeah, okay.
Yeah.
The old mute button.
Yeah, the old mute button.
Yep.
Yeah,
Okay.
so yeah, yeah. So I guess the main thing that jumps out at me from this latest survey, really almost more than anything else, is that in this month-over-month period, we've seen a rise in expectations of inflation being transitory. When everything that I hear from everybody who seems like the smart money, even on the pundit side or fund managers or anything that I kind of listen to or access in terms of research suggests that this exact period is the period when it really we lost that pillar that Powell outlined in the Jackson Hole speech, where this has shifted to being no longer about a few idiosyncratic areas. It's become unquestionably broad-based inflation, and the fact that that's happened, that's exactly what one would imagine, if sustained over any length of time, would start to change consumer expectations, which is the driver of non-transitory inflation. And so it's interesting to me to see large money managers actually become more convinced during this period that it's transitory. Maybe that's because some of the second derivative effects of some of the spiking price areas, we've seen a slowdown in the increase of certain prices. So that they're still increasing, but they're not increasing as fast. And some of the supply chain issues like semiconductors on a month over month basis, the lag time, the lead time or whatever is has increased, but it's increased over the last month by less than it has over any month in the last 6 months. So there's a second derivative slowdown in some of these issues, and maybe that's what they're hinging it on. But it's just a really interesting observation. I think that this period where it's become broad based is when we're starting to see an uptick in large money managers buying into the transitory narrative completely.
Yeah, and the inflation narrative will obviously remain a key watch for the markets. Some of the things that I was looking at recently, the president of the Port of Los Angeles said that there was a 29% reduction in the amount of containers that were
Hmm.
out in its port. So that's obviously a good sign. We saw Toyota Motors come out 2 weeks ago suggesting that they saw December as the end of when we're going to have that crunch in semiconductors for the auto companies. NXPI, one of the biggest auto semiconductor supplier out there, was also making some positive commentary about the supply chains continuing to improve. So it seems like we've hit a trough, at least on that front. One of the big things that I think is being missed here, Brett, is pull through orders that likely impacted the supply chain and everything as well. Because I'm just looking at some of these inventory levels that in the retailers that are reporting. Macy's this morning up 19%. We saw Target up 12%. Walmart inventories up 11%. What and also I would include the retail sales number, which was a big beat.
Well,
My thought, Brett, is that we're
okay, tell
seeing
me.
a lot of pull through orders, right?
But so by that, I mean, so what I hear when I see these inventories going up is fear.
Fear, correct. Because
Okay, that's what you mean by pull through. Like they want to stockpile now
they
because
want
if
to
things
they're
get worse, it's going to hit
stockpiling
their holiday
and
sales.
everybody's doing it and
Yeah,
everybody's
right. Well, that's
stockpiling
what
too.
drives inflation, right? I mean,
No,
that's
exactly. But
as long as
what
the
I'm
money is
saying is
supplied to do it.
what I'm saying is you're seeing evidence of some of the areas that popped up. Obviously, gasoline being a real key driver there too, and we got that search by the FTC to go in and shake that up a little bit. So that'll be interesting to see how that plays out. But
Okay, so
from
I'm in
from
total agreement,
from
but I
the
want to highlight something
from,
before you go on. Can I just
yeah,
highlight that this
sure.
is the expectations change? When they
Right.
say, like, is it becoming is our inflation expectations changing? Well, what you just highlighted is evidence of that.
I know, and that's what I was getting to is basically this is what I'm curious to see of why they're changing it. So, with that retail sales number, for instance, I asked Pat what percentage of it did he think was pull through, what inflation, and
Mhm,
what just strong consumer spend, and he basically assigned a third to each. So
mhm.
a third of the beat was due to higher inflation, obviously higher prices. If you're buying something, the number's automatically going to go up a 6% according to the CPI basis, right, from the prior year. We also saw he thought a third was pull through orders, people lining up, getting that inventory build in there to avoid getting caught being flat footed during the holiday season. And we've certainly seen evidence of that. And then a third of it just strong consumer spending. We know that everyone's flush with cash. So, what I'm going to be real curious to see is how the market reacts if we do get a little bit of a drop off in retail sales numbers in November and December, months that are generally historically strong, but are going to see weaker year over year comps because we saw more activity going in October, because we saw pull through orders, because people were shopping a little bit earlier to make sure that they could get Turbo Man or whatever it is that they needed to get for the kids. So that is probably where I would see that inflation expectations being kind of softened with the idea that perhaps this is occurring. So I think over the next few weeks and certainly in the Q4 earnings season, and when we get the November and December data around retail sales and obviously inflation, it's going to be real interesting to see if that transitory argument can. Kind of gain some muster, if you will. But certainly from the commentary, as you were saying about the Fed, it's definitely a little cautious out there.
There's another factor too that I wouldn't be completely dismissive of, which is during the pandemic, we saw personal savings as a share of disposable income go through the roof to like
Sure.
all and so some part of this is like burning that off. Like people are getting back that they saved up, they stored money the same way you're talking about Target storing inventory. Like, will I lose my job next week? We're not, we're going to keep, and they were being supplied money through different
Right.
fiscal measures. But so the combination of the two is they built up this big thing of acorns because the bad winter is coming, and then suddenly the sun's back out and now all those acorns are going out the door and they'll go back to a normal rate of savings on any new incoming income. So the part of what's driving the end consumer demand could be a little bit just burning off that giant stockpile of savings.
Yeah, no, no argument there, and obviously that's certainly working its way into the inflationary spiral
and
too. And
and at
when
some
we
point it's going to be gone, so it means just
right,
about back down now,
yeah,
so that could help.
again, that's another data point that bears watching. So, I've just found the recent retail reports that we've been looking at extremely interesting from that aspect.
Hmm.
But let's move on to the next slide here. And these were just some flows of interest that were jumping out from the Bank of America flow show here. 4-week moving average for equities, that was the largest since May of 2020.
For
Certainly
equity inflows of
for
cash flow.
equity inflows,
Yeah.
correct. So obviously, stocks remain hot. We're seeing that reflected as we're speaking right now. We're seeing the Nasdaq actually break out above the 16,400 level. So we continue to see equities finding that inflow. Bonds had the largest inflow in 8 weeks, and to be clear, that's corporate bonds. And we're going to break that down in a little bit here. Actually, right now in the next slide, which saw the largest flow to high yield since April 2021 and investment grade in 6 weeks. However, on the T bill side, it saw the largest outflow from bonds since May 2021. So, do you just think that people are viewing corporate America as in a little bit better shape than the government, Brett? How do you kind of fit that square peg into the hole?
The next 6 months is going to be a strong economy. There's no credit risk lending to companies.
All right.
And but the government bonds are massively overvalued because of what we've gone through for the last 10 years.
All right, and obviously a wind down in the Fed buying themselves,
Yeah.
probably leading to an outflow there too.
And
Uh,
inflation and et cetera. Yeah, right, sure.
this was interesting. Now this is data from 2 weeks ago, but largest outflow from tech since June of 2021.
Yeah.
Now I jumped back and took a look at 2021. We were actually up 4% in the month of June
And it was,
Uh,
by the way, it was the other spike in the middle in that small trader call buying. So
okay,
it was
okay,
February, June, and now.
okay.
So think about that when we talk about the handoff idea. You're talking about, you know, a large managed money selling some of these positions they believe are overvalued, and retail traders coming in and buying them up.
So again, the classic weak hand, you would say, right?
Yes, except that happened in about 1998, and it took 2 more years for the market to top.
Right. Okay, and then we talked about this data point before. Fund managers survey 66% in stocks. That was a new high for the survey. We'll have to figure out that August 2013 number, Brett, just to see where the differences are there. But 17% in bonds. That was a new low for the Flow Show survey, and 10.4% in cash, which was the lowest since September of 2018. So obviously a lot of money's
Yep.
been put into play here, Brett. How do you view some of these flows and that cash level?
I mean, I would say so. It's not overweighting at 66%. It's just weighting, right? But that's the
Right.
highest. And it's just, here's where there isn't much risk. There's more risk in bonds, and nobody wants to be in cash right now because of the same reason why you saw that VIX term structure. They think that if there's anything that's going to be problematic, they're going to have time to change that positioning. They're not going to be hit by something, blindsided by something in the next few weeks or into the end of the year. And you've got this chase for performance. Uh, you- uh, you've got people who they're looking at that bonus possibility, and they don't see that there's near term risk in this market. So it makes sense to not have much cash, but they do see a risk of you know bonds being overvalued, interest rates going up, etc. So I think I mean that's the psychology I see behind these numbers.
All right. Here's a chart of the investors' overweight equities, Brett. Again, net percentage of FMS investors' overweight equities here up to 66%. And they obviously remain heavily exposed to equities. This was the biggest overweight since August of 2013. The allocation to the US increased 13% to 29% overweight. Been net overweight US since March of 2019. So obviously, this is the U.S. remains the best story for
Yeah.
investors, and we've seen a spike in COVID cases in Europe. Certainly, some poor growth numbers there. We're well aware of China and the issues around the property developers. So, anything in this chart or any of these numbers surprise you?
No, I guess it's just really interesting to see that dark blue line going straight up for a decade.
Yeah.
There's just no variation in the theme of US outperformance.
Yeah, I mean, obviously coming in off the great financial crisis, and this is also, you could say, I mean, I would have to go back and take the numbers, but I think it's probably about 14 trillion pumped in by the Fed over that time.
Yeah, it's just interesting.
So,
Maybe it's
uh,
also a little bit FANG too. I mean, like the Silicon
yeah,
Valley and the power of growing the world right
yeah,
there in this country.
yeah. I mean, obviously, global leaders in tech are across the board here in the U.S.
Yeah.
Um, then we'll move to the tech outflow here in the next slide. Where you can see the flows come in. You can, not very many below the negative line here, Brett, obviously. And you can see this is the largest outflow from tech since June of 2021. And behind it, there you have the 4 week moving average, which you could also see on a 4 week moving average, still positive, but uh, down and getting close to flat territory. Now, of interest, tech remains the most crowded trade according to a fund manager survey. And again, we talk about June 21, Nasdaq was up 4% that month. So, like Brett was saying, this could simply be a handoff from institutional to retail.
Yeah, I mean, you could look at the directionality, the causation direction being either way. Perhaps it's when you start seeing retail pumping so much money into these tech stocks through calls, that the valuation levels get to a point where people want to take some off the table on the institutional side. Or you could see it as, there's stocks up for sale on the institutional side and it gets snapped up by the call buying. Probably more the first story than the second story. But either way, you see these stocks continue to go higher, and there seems to be these outflows on the institutional side that pair up pretty well with spikes in retail small trader call buying.
Yeah, just keeping an eye on the market too, Brett, as the Nasdaq continues to rip higher.
Mhm.
Um, Cash allocations, again, we were talking about this, down to 10.4%. The trough in April of 2007, just ahead of the great financial crisis, was 11%. So interesting. Well, maybe not that interesting that we see levels down below this area. It is getting towards the historical lows. Are you expecting to see this number higher or lower the next time we take a look at this?
Cash levels,
Yeah.
I maybe a slight downtick.
Okay, fair enough.
Okay,
Uh,
obviously, I have no idea of the answer to that, but I could see a slight downtick just with this dynamic of coming into a seasonally strong period with very few perceived obvious risks. Maybe even if the market doesn't fly higher, you still see people wanting to be sitting in as little cash as possible right now until we get to
it
maybe year end.
it does raise the question, how do we push up to the next level, right? If there's not a lot of cash on the sidelines.
And
Uh,
especially if you see that call trader buying get to that February high, that's kind of what I'm suggesting
yeah,
there is, we might be reaching sort of I mean, maybe it can go much higher. It just that period was such an extraordinary moment for, I think, that retail side and that retail story. It's hard to imagine there being even more ammunition being deployed by that aspect, that piece of the pie, than we saw in February. And if we're close to the same levels in terms of options activity there on the call side right now, and we see cash levels from institutions getting down close to where they've typically gotten at their tightest point, then yeah, it's really difficult to understand where you get that the next fuel injection into the market.
all right, global growth expectations. They stabilized. We had a big decline. You can see that drop down in October. This was just ahead of, a lot of data just ahead of earnings season, a lot of concerns around supply chain, China. There's still a little bit of uncertainty around the Fed and some tapering, but we are seeing that stabilize and bounce back. It was net 3% compared to minus 6% last month. Peak was 91% in March 2021. We're nowhere near those extremes, but it's also funny when you look at the backdrop with this drop in expectations. You didn't really see much of a drop off in that dark blue line, which is the equity holdings. So it seems to me, Brett, like people are kind of looking at this as more of a year over year comp
That's what
and
I was going to say.
answering the
Right.
question there rather than I think
Right.
that things are going to fall off. I'm taking my money off the table here.
Yeah, and you could maybe make the same case about inflation story, but yeah, that you start to get to when you're saying between now and 6 months from now, what's going to be the change, and you got to realize that 6 months from now you're going to be comparing with 6 months ago when you already had some of these numbers in a very different place than they were. Let's say we've been comparing for a while. This global growth number has been comparing for a while to the depths of the pandemic over the last few months. You've got so big, yeah, like you're saying, big annual comparisons that you get the base effect idea shifting in terms of its trajectory over the next 6 months.
Right. Moving on to the next slide. Well, let's take a look at tail risk here. And we talked about the inflation uh, that move into the transitory camp, and we'll take a look at that chart. But as you can see here, the light blue is October, the dark blue is November, and there has definitely been an easing of fear around that. What's funny here, and again, we'll get into the CME rate story in two slides, a pop up in central bank rate hikes, Fed taper, and that's moved in, and that kind of strikes to me as concerns around a policy misstep. Then we got China. That's cooled off a little bit. Perhaps some of the actions they've taken around the property developers, easing some tensions there. Asset bubbles has jumped up a little bit. And I found the ECB minutes or the financial stability report that they posted, where we saw exuberance, the term used 5 different times, talking about some of the asset price valuations that are out there. But real curious to see asset bubbles popping up. COVID has popped up a little bit too. I wonder if there's a little bit of seasonality in there, Brett, in terms of we're getting closer to flu season. U.S. fiscal cliff, as Brett was talking about before, a possible black swan event pops in at number 5 here after not being on at all. Of course, we got December 3rd as a possible big date, and then others is uh, declined a little bit.
Well, didn't
Of
Yelp
these,
say it's December 15th now?
well, December 3rd is when the continuing resolution comes to an end.
But
They've got enough money till get to
they've got 12
December
days to fight about it,
15th.
right? Yeah.
Exactly,
Yeah.
exactly. So they're always able to rob Peter to pay Paul and stuff. Close a couple of parks or whatever it might be. But any of these tail risks jump out to you more so than the other, Brett?
No, I mean, I think like you said, the interesting thing is the big increase in the second one there. The possibility that the Fed is going to start to be they're going to be under so much pressure to start to react to inflation that it ends up, you know, leading to more tightening than necessary and um, killing the recovery. And it looks like that's what that fear is really about there.
Yeah, we're going to see some of those slides there. Next up, we got profit expectations stabilizing. Probably should have dropped this in front of the tail risk on hindsight here, but I think this is simply is very similar to the global growth expectations. This whole story is about the earnings season that we've just seen to me, Brett, in terms of the change in sentiment.
Yeah, sure, absolutely.
All right. So let's get into those rate expectations. And one of the interesting aspects going through putting these slides together, Brett, was the dichotomy between what the CME Fed Funds future is telling us and what we're seeing in the fund manager survey here. So CME Fed Funds futures pricing, and this is data from yesterday, so I doubt it's changed all that much, but they're pricing in an 85% chance of 2 hikes by the end of 2022. And this is up from 72% just last month, 22% from the post September meeting. 53% see a chance of 3 rate hikes by the end of 2022. Uh, June 2022 is now moved up as the first meeting with over 60% expectations for a rate hike. As Brett and I have discussed in the past, I believe it's still the story, Brett. The Fed's never moved on rates with that being below 60%, correct?
I think it might even be 68% or something, but yeah.
Okay.
I mean,
Um,
that's obviously a long ways away. That's number is going to move a lot, but yeah.
right. We got term premium, which is basically the what's used to entice bond buyers to come in. The rate that they're getting above what they think they could get in returns elsewhere. That's down to around 1.4% through 2031. Now, you want to compare that with the Fed's long term projection of 2.5%. So, what we're seeing here, Brett, is the idea in terms of the Fed funds futures, what they're looking at compared to what the Fed is looking at is they are the mindset that the Fed's going to have to raise faster than they expect. And in so doing, that could choke off the growth that the low rates are helping build. And therefore, that's going to probably push us back into a little bit of a recession and cause rates to remain depressed for a longer period of time. Thus, a policy misstep is what the CME is pricing in here. Before we get into a full discussion, I'm just going to show you the rate hike expectations now for the Fed for the fund managers survey, where we saw a big pop up to 39 from 24 in terms of who thinks how many think there's going to be 2 rate hikes in 2022. 1 rate hike that did decline a little bit to 37 from 44. So we've definitely seen more people run into the 2 rate hike area. Same thing with no rate hike in 2022. That's dropped down to just 13% from 24%. And then we see expectations for 3 rise up to 8% from 3%. So obviously nearly doubling, but still running a distant fourth here at the moment. And then 4, that's remained stable. Obviously, somebody out there or a couple of fund managers are pretty bearish on expectations or bullish, I suppose, and expecting the Fed to have to move faster than expected. But Brett, trying to compare these two numbers, obviously something is not jiving here between what we're seeing in the Fed funds futures rates and this fund manager survey. How are you taking into account all this data that we're looking at, and what's your biggest concerns about what could unfold?
So, yeah, I mean, I think you outlined it exactly right. It looks like there is, it looks like the Fed fund futures, and some of our market leading indicators are suggesting that there already has been a policy mistake. Because the only way to avoid this outcome, in theory, then would have been to have started in the past, starting to slowly cut the spigot off earlier, maybe starting last spring or over the summer in terms of QE, and then maybe, having one hike scheduled for early next year. And you start to kind of land this thing in a way where you've already cut off the building into the equation now of a rise in long-term inflation expectations on a broad-based level. So this pricing would suggest that a net over the broadest possible sample, there is a slight favoring of the idea that there's already been too much inflationary potential baked into the cake we have now, and that eventually the Fed is going to realize that they're cornered by that, and that they have to shift their priority from fostering growth to stamping out the risk of that escalating into something that's truly severe, and that shift in priorities breaks down the cycle. So, I mean, I think that's basically what you were saying. That's what we were talking about. And when you look at what fund managers are saying, they pretty much are roughly, they're maybe a little bit more hawkish than the Fed dots in the last meeting, but it's pretty close. So it's basically what the Fed has been marking out as its own assumptions about the future, which obviously suggests that, that there's a lack of a likelihood that inflation has been baked in too much, that they're going to have to hit the panic button midway through next year and hike 3 or 4 times quickly.
All right, let's take a look then. We'll scroll through some of these inflation slides. Here's one just past episodes if you're looking for data points to kind of take a look at in different areas. This is a pretty good chart for a highlight in some of the areas times we've seen inflation spike up. This is obviously the highest one that we've seen now, Brett, in about 30 years or so. Uh, and anything that you're finding sticking out from this chart?
No, I mean, it's tough for me to see this as an apples to apples comparison given the pandemic. So I
Yeah,
really
no,
can't
very
take a
fair.
whole lot away from this. I think that it really is about whether or not you start to see some of, like we were talking with the pull through, if you start to see indications that people are changing the way they behave now on the basis that they're starting to assume further problems either on the supply chain side or on inflation side looking out over the next 6 months or the next year. And when that behavior starts to become embedded into the basic functionality of agents in the economic system, then you have something that there's no way to stop other than draining liquidity out of the system.
All right. Inflation expectations. We've been talking a lot about this. Net 14% expect inflation to be lower. That means 51% of respondents expected lower, 37 expected higher. That's the lowest level since March of 2020. So definitely playing into what we're talking about, Brett, in terms of it certainly seems like markets are looking for things to slow down. And that's also reflected here in the transitory debate, which we were talking about earlier.
Yeah, right. So yeah, and but we've also got the base effects idea here too. So like if inflation stays right where it is, it's way above the Fed's target. It just doesn't increase. But if it stays there, for at 5 or 6% over the long term, that's a problem. So even if there's not a lot of expectations for it to go up to 7, 8, 9, 10%, um, it's tough to see that being too relevant for what ends up happening on the policy side.
All right. Then we got small cap stagflation. This is just highlighting the impact that inflation is having on some small business owners here. They're saying that inflation's the number one problem. Not a surprise. That was number one tail risk. And then we look at small business inflation concerns here, where you have the NFIB small business raising compensation next 3 months. That's been one of the primary concerns out there with the current rate of inflation. So nothing too surprising on that front, right, Brett?
No.
I think obviously with inflation on everybody's mind, one of the stories that's probably been underreported a little bit is the action in the greenback and how that could possibly also impact inflation. So, Brett, I know you've been pointing out in your commentary a lot the moves in the greenback. Certainly, some weakness in the euro at play is that's about 60% of the Dixie basket there. Um, I'll be curious to see if what goes on with sterling, with the Bank of England now firmly expected to raise rates on December 16th. But what are you seeing in the dollar, and what do you think people need to know?
Well, I mean, I think so. As we've gotten our bullet points down there, I think a lot of what's happening is there's such a stark contrast between where the United States is right now in this cycle and where Europe is. And the euro is 60% of the dollar index, and that I think is a big part of what we're seeing here. We've got an inflation problem in the United States. We've got roaring growth. We've got consumers still willing to spend a ton, even though we've got inflation. And we really don't have a COVID situation right now that is constraining behavior in any meaningful way that I could see. And in Europe, and we really don't have that much of an energy crisis. And in Europe, they have a bona fide energy crisis. We've seen some extraordinary things in terms of the actual changes in the price of any given unit of energy, no matter how you measure it. And that's for idiosyncratic regional issues. But also, we've seen Northern Europe go back into what is really a bona fide bad COVID wave over the last couple months. Germany's at its highest case load, I believe, yet for the entire pandemic. I don't know how much that's changing economic behavior, but you can see the tone from ECB officials is completely different from the tone that we're seeing from U.S. officials and anybody really looking at the degree. There's likely going to be at least a year difference in terms of when the ECB is going to hike rates first versus when the Fed is going to hike rates first. So I think that really explains what we're seeing here in the dollar.
Right, which for me, and here, this is the Dixie on a monthly chart here. For me, again, it points to that exuberance commentary from the ECB that I found to be so interesting. So, I'm curious if we might see them start trying to um, tighten that difference that Brett was just talking about. But for now, dollar definitely front running as the Fed's expected to move well in front of the ECB. All right, last two charts we got here, Brett. I just wanted to post this one. I thought this was a good one for the subs to have. Just kind of does a nice, neat look at the cycle of investments that we've been seeing here. Starting off, of course, with the COVID crash, and you had the bull flattening and the lockdown, uh, moving into a bull steepening here in Q3 and Q4 of 2020. 2021, we saw the bear steepening with the reopening trade taking effect. And now what they're looking at is the bear flattening with more inflation coming into play. You see, they're keeping an eye out on staples there, the VIX, some government treasuries. So this is just kind of a handy way of thinking of how this investment cycle's going. And with that 2022 in mind, I thought it was interesting to just throw this out for people to get ready for, where we're seeing emerging market equities as for the second year in a row, where fund managers are pointing to areas that they're going to have an interest in for the best returns. Obviously, a valuation play here.
Hmm.
S&P equities number 2, Bitcoin 3, oil 4, gold uh, number 5 here, and bonds still not expected um, to provide much of a return. Now, one of the questions that we had, Brett, was where do you want to put money in inflationary terms here? And I guess one of the things that I would question with emerging markets, and I threw the broken clock syndrome. We saw this last year, where it
Oh
seems
yeah.
like everybody's talking about this is the year for emerging markets in the U.S. As we're just talking about with that U.S. equities being overweight since 2019. Certainly tough to knock the U.S. off the perch. It's the best place to park your money. So, you got any thoughts on any of these 2022 investment destinations?
Yeah. Yeah. So when I grew up in Sarasota, Florida, a lot of I was New York and then Sarasota, Florida, and I grew up in a household during the 70s and 80s where the football team that was our team was the Tampa Bay Buccaneers. And I don't know if you know the Buccaneers from the 70s and 80s, but the Jaguars almost came close to being as bad as them recently, but the Bucks during that period were the worst team ever.
Yeah.
And every year it was the same thing. Well, we got this new guy, this is going to be their year. And I feel like this emerging market trade and the idea of value starting to beat growth is kind of like the Bucks of the early 1980s lately. And it seems like It's always 6 months out that this trade is going to start to work. We're going to see a value driven market. We're going to diversify into emerging markets, and we've seen this but it just always ends up being U.S. and tech just around every corner, and it's been a syndrome in terms of people forecasting what's coming, 6 months to a year from now in the market for years.
Yeah, I mean, as somebody that's had a bunch of cash tied up in EEM for a few years now, I could promise you it has not been the next destination for money. I mean, it hasn't lost me any money, I suppose, but
Eventually, it's
just
going to win a Super Bowl, but
yeah. Maybe they'll get Tom Brady, or in this case, I don't know, some
exactly
hyper dovish
right.
Fed. But the strong dollar that'll play an interesting aspect into this though too, as we're just discussing, because that should improve U.S. buying power overseas, and maybe that helps provide a boost. But at some point, they're going to need a little bit of a stronger currency and backdrop themselves to get things moving. China is going to have to be working through its property development issues for another couple of months. So always on the lookout for value and anything that could disrupt the U.S. But it's really tough to see anything that's going to knock us off the perch yet. I suppose they do have S&P 500 at number 2, so it's not like they're heading for the exits at all. And then, of course, Bitcoin coming in third. That should be of interest. And oil, again, I think that this little dip around the strategic reserve release is going to open up a nice buying opportunity for oil and energy going into next year, Brett.
So do I.
Okay, so let's do a little bit of a recap, Brett. You want to fire off first here?
Yeah, sure. I mean, so we have seen something that has typified really the last year kind of continue to be the case where you see this. I mean, it's been a transition over the last 18 months to a retail driven bull market. And it's the number one thing you got to know. And that's a very different market context than we've seen for maybe 20 to 25 years. And it just works differently. Like we've seen some of these. I mean, this is idiosyncratic in terms of this bull market. See the options ratios become so skewed, so chronically. But there's a lot of dynamics that just shift in terms of how you look at sentiment data and flows data, relatively speaking. So the institutions start to pull out of tech, and the retail traders right there to scoop them up and drive them higher. This is a sort of but the other thing is we are seeing, as we talked about earlier, a narrowing in breadth that I think is impossible to ignore. And we are seeing the gradual building in of the risk that's typified by some of the market leading uh, policy measures in terms of what we see with the Fed's funds futures, et cetera, where we're maybe baking in a situation that could become suddenly problematic. So you've got a lot of risk in the system. It continue for the next several months? Good chance it will. But it's gradually building up a vulnerability that's probably got some kind of overall cycle implications if we start to see that tone shift. So we're seeing a narrowing of breadth now. That doesn't mean it's over. We saw a narrowing of breadth again in 1998. If you go back and look at the financials, they topped in 98. They did not make a new high in 99 or 2000. Like we saw a lot of groups do that, but we still look at what happened in 1999 and 2000, and really for a 2-year period there where you didn't need much breadth. There was a concentrated movement, and it was driven by retail, and it took a long time before you hit any kind of serious top. And I'm not saying what's going to follow this is going to be what we saw from 2000 to 2002, not by any stretch of the imagination, but we are starting to narrow down. It may take a long time to get through the process. It may be that momentum traders that are trading bottom up on leverage are the ones who are going to get rich for the next 6 months to a year, but there's vulnerability building up nonetheless, and you can spot it in a lot of little places.
Yeah, I agree with everything Brett said. I talk a lot, obviously, on audio, and my running thought process is that I'm expecting to see a little bit of a shakeout sometime between now and the end of the year. When that comes is anybody's guess. But I think overall, markets should continue to maintain their momentum. I expect to see us close at near all-time highs across all indexes. Just a lot of liquidity out there, a lot of strength, a lot of bullish sentiment that could provide the lift here. A little bit of a FOMO trade too, Brett, I think, going into the end of the year, where you're going to have portfolio managers that maybe had been sitting out some of this rally really need to make year-end numbers and start looking at that. I know I'm always looking at how I'm doing against the S&P and the accounts that I manage, and that definitely plays into the psyche and something I think could lead to a little bit of a FOMO rally towards the end of the year. But as Brett was saying, there's definitely some pockets of vulnerability in there that we need to continue to watch, certainly on the breadth side of things. Some of the current issues with financials and oil that Brett was talking about, I do think that this is a little bit more headline related, with financials in regards to Brainerd possibly taking over and demanding higher capital levels. With oil and energy, a little bit of weakness due around to the strategic reserve releases. So I think that those are two areas that could see a dip, but open up a nice buying opportunity to expand the breadth into the end of the year. But 2022, I'm definitely going to be cautious because there's going to be a lot of tough comps going in. We'll see what continues on with the inflation expectations and the supply chain constraints, of course. But it's going to make for an interesting few months. But for now, I definitely think that you have to stay in the mindset of buying dips when they come about, and looking for a strong run into the end of the year based around the data and sentiment that we're seeing. We'll continue to be doing this. We'll be taking on one more look before the end of the year. Brett, it's going to be right around the Fed meeting and the potential for a breach of the debt ceiling too. So that could be an interesting time for us. But for now, my general thought is buying dips. Would you agree with that?
Yeah, so I got one more thought. It would be interesting to see if we get to the end of the year and we start next year and cash levels in institutional portfolios have gotten deeper down into sort of historically tight areas where you really don't see them get lower than that in cash. And we've got small trader call buying maybe at or above the level we saw in February, and you've got a nice setup for some kind of corrective move at that
Yeah.
point. So you run this thing into the year end, you get those calls up to that February level, you get that cash down to historic lows, and there really just won't be any more powder left. You really got the FOMO trade in terms of performance chasing off the table, and we're set up for the possibility of like a January correction. That's one scenario I could see playing out that
Yeah.
matches all of this information.
Exactly, and that's currently my baseline, I would say. So,
Okay.
all right, we're on the same page, which is always good, right, Brett? Okay, that's going to do it for this time around. We look forward to talking to everybody in December. We will have our trader strategy meeting in, I think, about week and a half time, right, Brett?
Yeah.
So you'll be hearing from us again, and obviously constantly on the site too. So any questions with regards to this, please feel free to write in. We'd be happy to answer them. Brett, as always, thanks for joining us here. It's always important to get your message out there and for people to understand what you're looking at because you're usually pretty tied into the markets here. So thanks for joining us.
Well, you as well, and thank you, Gav.
All
All
right,
right.
we'll talk to you soon.
Okay. Take care.